Hi folks, now before we start the video, JK, a question to you. If you weren't in finance or the currency field, what would you be doing right now?
Oh, hey, good morning to everyone. That was a googly actually. Yes, I would have been into music, I think.
Oh,
Some sort of
wow.
music.
Uh,
Yeah,
like an instrument player, a singer.
instrument.
Which instrument, sir?
Keyboard
Keyboard. So
yeah,
do you play keyboard?
to some extent, yes.
Indian
But long back, I learned a bit and then stopped. Yeah.
Okay, so JK, are you our in-house Billy Joel?
No, not really. Actually, my daughter is kind of she performs.
Okay.
Even in US also she has performed.
Mhm.
And my mother used to be a good singer,
Wow.
so it's kind of background to it.
Brilliant.
Yeah.
Now, I would also like to ask the same question to all of you watching. Tell us what you would be doing if you weren't in the field right now. So comment below and let us know. I personally think if I wasn't in finance, I would probably be a pilot because that's something I wanted to do. Now, this week we had a lot of data. It was an eventful, power-packed week. And the major themes were, of course, we had the RBI rate decision, we had the US CPI data, and we also had the ECB policy meeting. Now, let us discuss what's been happening in India first. RBI this week raised its key interest rates for a second straight month. The MPC raised the repurchase rate by 50 basis to 4.9%. Now, this, of course, means India has joined 50 other central banks, including the US Fed, to have raised rates by 50 basis in one go. Now, this is crucial. Worldwide, we have been seeing record inflationary pressures, and India isn't immune to the global forces. JK, the governor seems to have dropped the phrase staying accommodative, and it seems as if we are battling inflation head on. Uh, if I bring your attention to the first slide, it's somewhat clear that we have been more or less following the US when it comes to the rates. What is more to come for India? Where are you seeing the terminal rates for this year?
Yeah, back to some serious stuff. RBI, whatever they did this week was par for the course, given the rise in India's inflation rate to multi-year highs. Like the hike on May 4th, which was in fact outside of the regular meetings, the rise of repo rate by 0.5% in this meeting was what was expected. And also, that will be matching what Fed will do on June 15th. RBI also raised the inflation projection from 5.7 to 6.7, while retaining GDP at 7.2%. But given the higher inflation projection, we are expecting the rates to be hiked by RBI further by at least 0.75% this year, and possibly FY23 end policy rate at 5.8 to 6%. Removing the accommodative stance and shifting focus to inflation fight has ensured the credibility of RBI is maintained. There may be more liquidity tightening measures as well in the coming months. Now, what concerns me more is the new climate of steady rise in rates and market yields, how the large borrowing program from the government will go through. Though RBI governor said that they would ensure it's a smooth, happening, we remain skeptical that market has an appetite to absorb the Indian paper to such a large extent. Besides, higher borrowing costs would further increase the fiscal deficit of the government substantially. Higher deficit may lead to reduced government expenditure, in which case the expected growth rate cannot be maintained. Thus, we are in a vicious cycle with challenge for us being not just getting a handle on the inflation, but to manage the tight situation on the fiscal and growth front. With the foreigner apathy to Indian markets continuing, we are really in an unenviable position, Swaraj.
So, if I were to get what you are saying, is that when the rates rise, when government is borrowing, when government has to pay for its borrowing by more, like a larger extent, of course, what they can spend on their fiscal measures reduces, like what they can spend for the economy, which is why it's like if the rates go up, the borrowing costs go up, and in fact, the government can spend lesser on people and on growth projects. Am I correct?
Exactly. Exactly. Yeah.
Yeah. I would like to move on to the second event which we had, which was ECB's policy meeting. Uh, President Lagarde said that the asset purchase will end this month and committed to a 25 basis point rise at the next meeting, and asked markets to even brace for a 50 basis hike in September, unless, of course, the inflation is seen coming down. Now, of course, that sounds quite hawkish. And as per conventional wisdom, if rate expectations are higher, and if all else are equal, then euro should technically rise. But that has not happened. JK, why did we see a sharp fall in euro during the statement?
You're right, Swaraj. When Fed sounded hawkish, market bought dollars, but when others did, their currency was sold. This happened with two central banks' decisions this week. Australia raised their policy rate by 0.5% versus 0.25% expected. And AUD is now 2% down from the peak seen after the decision. Similar is the fate after Europe ended the bond buying program and indicated the first rate hike in June to be followed by more in the year. Market is actually discounting up to 140 basis points of rise in official rates by ECB this year. But within two sessions, euro is down by more than 2%. If you point to US inflation being at a 40-year high, the same has been the case with Europe. So there is a huge divergence in the reaction of the market to the rate rises by the central banks. But what explains this divergent reaction is the potential for stagflation in Europe, which is far higher compared to US, particularly after the Russian oil import ban. Besides, Europe still struggles to manage the 19 divergent economies with one fits all monetary policy. In the current scenario, we have the bond yields in Italy soaring as they have structural issues which will be further worsened due to import ban, and a rate rise affects them even more. Outlook for Italian growth has been worsening steadily. ECB has actually been contemplating continuing the bond purchase support, especially for some peripheral markets like Italy, which is called fragmentation, rather financial fragmentation. However, they stopped short of announcing any such program, which was also taken negatively by the market. Now, despite all these unique challenges, what can save the euro from a deeper crash is the Europe's keenness to maintain the stability, and a currency collapse will therefore be something they would like to avoid. We have another currency in Asia, the Japanese yen, which has weakened to a new 20-year low against the dollar. Despite their statement that a weak yen helps the economy, Japanese authorities are increasingly getting jittery about the one-sided move affecting their business and the confidence in the economy. With two major currencies almost in a similar situation, one cannot rule out a direct market intervention to stop the soaring dollar from appreciating further. So it is not just about the monetary policies, but the intention and firmness of the authorities to deal with currency's weakness to maintain macro stability, which would save them eventually. And that is what I expect to happen eventually in Japan as well as Europe, a direct foreign exchange intervention.
Mm-hmm. JK, one point which I want to touch upon, which you mentioned in your statement, was fragmentation and the ECB using one fit all policy. We have seen, as you mentioned, the Italy's bond being under pressure, and I just like if you could just explain to our viewers what it is, what fragmentation is, and like because we are seeing a lot of things. If you see the spread between the Italian and the German
bonds,
yes,
yeah.
German bonds, we are seeing a sharp rise in their spread, as shown in the chart in your screens.
Yeah.
So, what exactly is fragmentation? If you could just explain.
So, if you had followed my statement initially about Europe, they have actually stopped their bond buying program this month.
Mm-hmm.
But they are making an exception just to accommodate some support for the countries like Italy, which require extra support to maintain stability in their bond market. Italian bonds have been facing huge sell-off, and their uh, spread with the German bonds has been widening greatly, which is actually a sign of stress in their market. Also, as I said, Italian growth is under pressure. Now, what ECB is contemplating is possibly make an exception and buy only bonds of those countries which are under extreme stress, so that no, they remain supported, and so long as until they reach some stability. This is what is called fragmentation. Otherwise, the earlier bond program was applicable to all the countries. They used to buy the bonds of all the other countries when they wanted to infuse liquidity through quantitative easing. That is what it is meant.
Okay. Thank you, JK, for explaining that. And lastly, I want to touch upon the US CPI data, which came in on Friday. We saw some stronger than expected inflation figures. It hit a 40-year high in May. This has, of course, put more pressure on Fed, as this reinforces that inflation is still heated. JK, what are your thoughts on this? And if you could just share your closing thoughts on the dollar as well.
So I think just like the NFP last week, market went into the CPI data expecting some moderation after the recent data had led many to believe that inflation may be peaking in US. But we were in for a rude shock, and most importantly, the core month-on-month inflation hit 1% as against 0.3% last month and beat expectation of 0.7% by a wide margin. On a year-on-year basis, both core and headline inflation jumped more than expected. Now, the reversal in core goods inflation was bolstered by the steady climb higher in core services inflation, which rose 0.6% in May. Leisure and hospitality related sectors once again low, and there was a huge rise in the airfares by 12.6%, and they are now up 37.8% year on year. So this is some segments which have been seeing huge rises in the cost and leading to the core inflation getting higher. The reaction of the market has been very strong, rise in yields and the dollar, while stocks took it on their chin. Now, majority expect a rise of 0.5% in June, July, and even September now, while the terminal rate has gone up to 3.65 from the earlier 3%. Equity investors are watching anxiously the yield spread between 5 and 10 and 5 and 30, both inverting, while 2 over 10 has flattened quite a bit from what it was earlier in the week. Most analysts expect a recession next year, as Fed will get into hefty rate rises and focus on reining in inflation even at the cost of growth. Some segments of the economy are already slowing, and the consumer sentiment is worsening, as evidenced by a big fall in the Michigan Consumer Sentiment Survey on Friday. Now, let's not forget that the quantitative tightening is also starting this month. And all in all, a tough year ahead for investors, both in bonds and shares. Now, one more point to note is that yields are rising, but with rising yields, the real yields are falling faster. And very likely they will return, very unlikely they will return positive for many months. This seems to have guided a fresh rally in gold on Friday, and the nature of the move indicates that we may be potentially seeing much larger gain for the yellow metal. Now, people have been selling bonds, people have been selling stocks, and possibly they are diverting some of that money ultimately into gold, as has been pointed to by many analysts for a long time. Now, talking of the dollar itself, it looks like a fresh rally in the works, and we may be retesting the previous high of 105 in the coming week, particularly after the Fed decision on Wednesday, 15th.
Okay. And of course, you mentioned the Michigan consumer sentiment for an economy like US, which is so consumer driven. These numbers are very important because, of course, they indicate how the economy is doing. Thank you so much, JK, for coming in from, of course, you're in US now. So taking the time out at very odd hours to do this session with all of us. And that's all for now, folks.
Yes, Saraj, just a minute. I think I just wanted to point out that, one of the other challenges that is also possibly going to get some more attention in the coming days is the rising COVID cases also in the country. In fact, I've been hearing some of once again, like third wave, hearing some known people and their families also affected. So I think this is not getting much attention now, but this is in the current circumstances, even this can add to the challenge for the Indian economy, actually.
Yeah,
So I request everyone to be safe.
yeah, absolutely, absolutely. We all need to mask up, of course, when we are going out in public. Take precautions,
Yes.
sanitize our hands. That's, I think, it seems like it's not leaving us anytime soon. And yeah, that's all for now, folks. Our weekly series will be now done twice a month. So don't forget to like, share, and subscribe to the Almus YouTube channel to keep up with the latest developments in the world of finance. We do Market Mornings, which is like a daily series, and of course, we bring to you more rich contents throughout the week. So thank you, everyone. We'll see you all very, very soon. That's it. Thank you.